today's top three things. Number one, the U.S. dollar. Number two, emerging markets. And number three, gold. Going through the U.S. dollar, we went up last week, obviously, with the Europeans deciding to cut interest rates, so that was the biggest factor in driving the dollar higher. This week, of course, you have Janet Yellen on Thursday, which will have impact, I'm assuming, but again, you should never assume anything is 100% assumed. Looking at the dollar, though, versus levels is what really matters here. The trend line for the U.S. dollar index is 81.29, closed just above that on Friday and pulls back this morning. So again, it's a really kind of I guess a kind of tippy-toppy spot here for the dollar. And again, will it hold? As of this morning, the answer is no. Emerging markets, number two. I mean, last week's strong dollar equals what? Equals down emerging markets. Whether you look at last week's move in the MSCI Emerging Market Index down 1.7% for the week, or if you look at the MSCI Latin American Index down 2.8% for the week. By the way, that index is still down 13% for the year. What do these things have in common with gold, which I'll go through in a second? They don't like strong dollar and rising interest rates. So let's just go through that. Public enemy number one of gold is rising interest rates and a strong dollar. You had both last week. The 10-year bond yield was up 13 basis points to 2.75%, and gold continued to crash. So again, you got to be really careful here. You know, thank God we sold gold just after like a 2-day holding period. But again, positive P&L is what it is. People can whine about it. But the reality is that gold was down 1.9% last week. It's down now another 0.5% this morning, down over 24% for the year to date. And again, if interest rates rise and the dollar goes up, gold will go down. If the opposite occurs, the opposite will occur, or at least that's what the macro market's telling you for now. So those are your top three things.